Hi everyone. Today we will talk about one of the favorite ratios of Warren Buffett. All of us know that Warren Buffett is one of the greatest investors in stock market. He is known for his ability to pick very high growth stocks. So the ratio which I am going to talk about is called PE ratio. Now before I tell you about PE ratio, let me quickly recap in very brief about EPS, which is earning per share. So EPS is net profit divided by total number of shares. I had explained this through an example of ITC shares. So the ITC made net profit of 14,802 crores and the total number of shares is 1,232 crores. So the EPS was 12.01 per share, which is approximately 12. Now, if you have understood EPS, which is net profit per individual share, then let's try to understand P ratio. P ratio or price to earning ratio is market price divided by EPS. Price is the trading price which you see on stock exchanges like BSE and NSE. So again, taking the example of ITC, let's try to see if we are able to calculate P ratio of ITC. Its market price is 251 rupees per share and the EPS as we calculated was 12.01 per share. So the ratio is 12.9. So this ratio tells you how overvalued or expensive is one share of ITC with respect to its EPS. In the ideal world, the market price should have been 12.01 per share, but since it is a real world driven by a lot of emotions, perceptions, etc., it is 251 per share. You can understand this through this example as well. A shop makes profit of 12 rupees per year, but people are willing to buy it at 240 also, which is 20 times its actual earning, hoping that in future the shop will start making insane amount of money, and hence with this perception they buy a overvalued stock. So if you look at Skinner.in, then price is 260 rupees and EPS is 12. So if you divide them, you get 21.6, which is the stock PE ratio. But also keep in mind that PE ratio is one of the many factors which determine the quality of a stock, and hence you should not ignore or reject a stock just because its PE ratio is very high. So let's see if you have understood the concept of PE ratio and answer this question. What factors decide share price? Is it net profit of the company, or is it perceptions, emotions, good growth, fairy tales about company, or it is based on market manipulation, insider trading, higher attention due to any event? Now, if it was an ideal world, I would have said net profit is the only answer and other two should not have impacted the share prices. But since we are living in a value, all these factors determine the share price. And that's how you see that a stock can have a PE ratio of 20 or even 100 or even more than that. Now, let me help you understand this through an example as well. So if you look at this news, Tata Motors to raise 1 billion in its passenger electric vehicle business at a valuation of up to 9.1 billion from TPG Rise Climate. Now this news was announced on 12 October 2021. Now in the ideal world, the investment should have come. Tata Motors should have utilized those investment and produced a lot of electric vehicles, and that would have generated profit, and then the market should have reacted either positively or negatively. But what happened, as soon as the announcement came, stock market almost shot up by 47%. 11th October it was 415, but on 14th October it was 400, it was 497. And if you see the insider trading or the manipulation and in this range, if you look at on 6th October it was 336 and by 11 it was 415. So the big bulls would have gotten news of such investment much earlier than we as a retail investors, and definitely they would have made more profit. So that's how market works, and we as a retail investors have to be very cautious when to invest and when to sell a stock. Your investment decisions should not be based on news or any kind of unsolicited investment advices. Now let's quickly summarize points to remember while analyzing PE ratio. First, P tells you how expensive is a stock beyond its ideal worth. Now, second point I want to make is that it becomes very difficult if you are hell bent on finding lower PE ratio companies, because we as retail investors always get news or catch hold of companies much later. So does that mean we should stop investment in a companies with high PE ratio? Hence, P of a stock is usually ignored if EPS is increasing consistently and company is growing year on year. And let me help you understand this through an example. So if you look at Asian Paints, its P is 99.8, which seems very high. But does that mean you should not invest in Asian Paints now? The answer would be no. I firmly believe that Asian Paints is one of the best stocks in Indian market. And let me help you substantiate it. So if you look at the peers of Asian Paints, which is Berger Paints, Nerolac, AkzoNobel, Indigo Paints, Shalimar Paints, etc. Now look at the EPS. Previous EPS was 28.0, last year's EPS was 32.73, and in this trailing year, it is 31.61. So you can see that EPS is consistent and it is marginally increasing as well. And at the same time, if you look at the peers, they are way behind except AkzoNobel, which has a very high EPS. But since it is out of top three, I don't prefer such stocks. To minimize your risk, you should always stick with top three players in Indian market. Last point which you should consider before analyzing any company with their PE ratio is that you should only compare PE ratio with peer companies. So if you are analyzing HUL and its PE, you should look at the PE of its peers as well. But let me add an exception here. If you are analyzing banking stocks, you should ignore PE ratio because for banks is different kind of analysis and PE ratio is not one of the factors which should be considered there. Hope you like this video. Let me know if you have any questions and I'll try to answer them in comment section. Thank you.